My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to save you a little money here. My job is not just to entertain, but to educate you. Explain days like today. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Stay the course until the job is done. There. That's really all that Fed Chief Jay Powell committed to today. And while Wall Street hated it, with the Dow plunging 505 points, S&P plummeting 2.50%, and NASDAQ nosediving 3.36%. It's what needs to happen to stamp out inflation that robs you of your purchasing power. Powell knows he's done a lot to cool down the economy, but he also knows, and said it so many times, that he's far from done. It's his game plan. He's sticking with it. I really do not envy Powell. Every sentence parsed, every word analyzed. Plus, his job right now is to bring the pain. The house of pain. Not create the gain.
House of pleasure.
So his job isn't fun. But all you really know at this moment is that, like a ball game, the tightening's not over until the fat lady sings. The fat lady being inflation. By that metric, the ball game's nowhere near over, and it's not really much use guessing which inning we're in, although people constantly do that. I can tell you this, we're definitely not at the seventh inning stretch. Now, traders are jumpy by nature. They look at Powell's 2 p.m. statement, and he issues a statement before he has a press conference. You know what? It had some new language in it, saying that the Fed's conscious that its actions take time to play out. That was regarded as being the signal to buy. They went crazy, buying everything, thinking that, therefore, because he put that phrase in, he's going dovish. To belabor the ballgame analogy, the traders took a real long lead off of first, betting they had a chance of reaching home plate on a single, because Powell said he's mindful that parts of the economy are slowing, like housing. But by the time Powell's press conference started, he picked off the traders like he was taking Halloween candy from a baby. The traders remain convinced he'll signal someday that he's done tightening. Later, he'll have a press conference and say, you know what? I'm done tightening. You go buy stocks. Unfortunately, that's not how it works. It's never worked that way. I've been telling you that for 17 years. It's not how it works. And we found out during that unfortunate press conference, or at least unfortunate for the short-term bulls. Here's how the moment really works. The Fed's job right now is to crush inflation. For that to happen, we need wages to stabilize, not go higher, and that means higher unemployment. We don't have that yet. We're not even close to that yet. But Powell's told us time and again that it has to happen before he'll stop raising rates. He's been consistent because he doesn't want another flare-up after he does declare victory, which eventually he will. The big question is, why did traders believe Powell was going to say the following? You know what? We have wage hikes all over the place. We have no real price stability in the supermarket. We have far more jobs than we can fill. Only housing and commodities have actually reversed in price. So I guess we're done. Go buy stocks. Buy. Well, you know, that's insane, people. Powell's simply not worried about tightening too much. Not with unemployment at 3.5%, you know, almost all-time low. He's only worried about tightening too little. That's it. It's very binary. So what do we do with that knowledge? Okay, listen. This year we've seen rate hikes go up by 375 basis points. That's monumental. And we have to consider that the Fed staying the course means that you might have to adjust your portfolio and that you can still do it after we've had a nice run. Because many stocks that do well in an advance do poorly in a slowdown. While selling the stocks that need a strong economy in order to thrive makes sense. Still, we're still doing it for the investing club. Now, let me tell you, let's put all that aside, because I really want to start distinguishing, because I was talking about this yesterday with Sharon Epperson and Tyler Matheson on a really great program. If you're an index fund guy, right, you know what? The market's overbought, but it comes down. You put some money to work. I will. You don't have to care about any of this. If you keep all your money in index funds, all you should worry about is that Powell might throw in the towel and stop fighting inflation before he's won. Why? Because it would mean that even if your portfolio went up, it might be worth a lot less when you go to withdraw your money in 10 or 20 or 30 years. You don't need to concern yourself with these short-term gyrations in the market, although I would say if you follow the investing club, when we talk about a market being oversold, that's when you commit money for your index fund. That's what I do. But if I can't own individual stocks. I can only own stocks for my trust for the club. But if you're holding your own portfolio, if you're building it, okay, what you heard today is a big deal. All year, the market's been going through this incredible leadership change. Tech of all stripes is now the enemy. In the old days, it seemed like they'd do well no matter what. That turned out to be wrong. We've been trimming these stocks forever. If you're hanging on to anything tech, you have to recognize you're going to take a drubbing with a profitable company and get shellacked by a loser. If you're invested in a company that came public in the last 2 years, you're going to get a real beatdown. Sell. If you own a SPAC, you're going to get crushed. That's because Jay Powell's down there giving you the business. He's not specifically targeting these companies. He's not saying, it's time to sell the semis. That's not his game. He's targeting the system that allowed them to come public in the first place and command ridiculous valuations. He doesn't necessarily want tech stocks down, but Wall Street's created too many of them, and now they're running out of customers because of the slowdown. They are the epicenter of this decline. Most of these newly minted tech stocks require endless economic growth because without new customers, their business models break down. Hardly a day goes by without one of these companies reporting a seemingly good quarter, 40% growth, lots of new contracts, and then they tell you the process of getting new customers has elongated. Elongated is code for our business is slowing and we have way too many employees. Now, if you own any one of these newer tech companies, believe me, that's what's happening. That's why I keep telling you they're unsafe at any speed. Does my trust own some Alphabet? Absolutely. That's an inexpensive stock. But these kinds of stocks, these are new, fresh, and they are going to fail. This same dynamic is why I come out here every night and say, don't buy, or sell to every company in any industry that loses money. The odds that these companies simply won't be able to outlast Jay Powell at the blackjack table, they're going to go bust. That's right, bust. In fact, it's worse. The Fed needs them to go bust in order to push up the unemployment rate. It's especially bad when you're dealing with companies that allow you to do anything with data. We have so many enterprise software plays that help massage data, analyze data, prune data, organize data, use data to get new customers, store data, sift through data, make data come alive in all sorts of different vehicles. Data has become fool's gold. Data is iron pyrite. When you hear the word data and you see a loss, I don't care what kind of growth the company has. I don't care what kind of software it owns. It is bad. But you know what? You know what's not bad? How about Johnson & Johnson, which is breaking up into two separate companies, consumer packaged goods play that won't get hurt by the Fed's mandated recession, Band-Aids, you're not going to use them, and a fast-growing pharma/med tech play that's going to save your life. Same goes for Eli Lilly, big pharma company, had them on last night. Terrific diabetes franchise, added advantage of allowing you to lose 25 pounds if it gets approved by the FDA. I'll take that. How about a company that, I don't know, that brews beer like Constellation Brands? How about oil companies with generous variable dividends as they come down? Oh, how about banks that just got a big earnings boost today because every time the Fed tightens, they can take your deposits, pay you next to nothing, and then invest them in short-term treasuries risk-free. That's what the leadership it is. That's where the money's going. Sure, one day the fat lady's going to sing in the bank's case. It means loans will start going bad. But these stocks now trade like a huge percentage of the loans will sour. And I just don't see that happening. Of course, the Fed has to thread the needle here. They need to spread the wealth of layoffs, make it so they aren't all software or hardware related. But like the recession of 2001, the layoffs are going to be heavily concentrated in tech, in newly created tech, in tech that you may own. The money that's left in these source stocks will be, as I've said over and over again, sources of funds for their survivors, donors to the banks and the drugs. It's why we keep trimming these names from my charitable trusts. They're well below the weight of the S&P, and it's still not enough. The bottom line, do not be conned by SPAC men. Don't get your head blown off by software as a sinkhole. My new nickname for the entire crowd of cloud-based software data center that didn't make it to the promised land 20-odd years ago and won't do it again. How about we go to Justin in New York? Justin.
Hey, Jim. How's it going?
Hey.
I would like to first say I'm a huge fan of your show. Been watching for a long time. And my best friend, Ethan PL, is a huge fan as well. The travel sector has been on a roller coaster, but surprisingly, it's held up relatively well so far in 2022. What are your thoughts on Marriott for the rest of the year going into 2023?
Look, I think it's a great company, but it's not the right time to own it. I mean, for instance, let me give you an example. We had Brian Chesky on last night. Now, he happens to be for Airbnb, which you could argue is the enemy of Marriott. I thought he told a great story. The stock got crushed. What is going to happen to Marriott? I think you have to wait for that stock to go down again before I touch it. Now, listen, I'm asking you not to be calmed by the SPAC man, the cloud stocks, the data stocks, this software as a sinkhole. Oh, man, but tonight, AMD is struggling of late, so after earnings, put it down from 160 to 60. I mean, where could the chipmaker be headed now? I'm checking in with the CEO. And retail's been a tough corner of the market. But where do I come down on some apparel stocks? I've actually found some that soon will be a buy. And AP CEO announced he's stepping down at the beginning of next year. So I'm seeing where the transition stands with the company's top brass. I need you to stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.